Today we're going to talk about strategic tax and equity planning for multifamily assets. I've been in the apartment business now for over 30 years, and during that time I've talked with literally hundreds of apartment owners about their assets and their plans to convert the asset into a long-term stream of income. Many of them have wanted to sell their properties, but the alternatives for reinvestment of the proceeds were unacceptable. As you know, the options are, number one, you can sell the property and pay the tax, which in today's market, take those proceeds and put them in a market fund. The return is really not acceptable. The other option is to do a 1031 exchange, which many like the idea of, but in practice, it's not too acceptable. You're trying to replace one problem with another, and then finding the asset that's acceptable is very difficult. So they end up with the third option, which is you just continue to operate the property as you did in the past. Today we're going to show you a little known and highly underutilized alternative that I think many of you are going to find certainly more acceptable and more attractive than the options that we've just discussed. We're going to show you how owners of investment real estate can use existing IRS codes and convert their equity into a tax-free stream of income that at least matches, if not exceeds, what they're already getting off of the operations of the property. In order to do this, I'll introduce two different disposition alternatives. One that has debt, one that is debt-free, and show you how this program can work for either scenario. As you know, our national politicians are currently grappling with severe budgetary shortfalls and have already put Americans on notice that at the end of 2012, the existing Bush tax cuts, which were historically the lowest ever, are going to expire. That means the 15% capital gains rate will go away, and forecasts are that it would go to 28%, and some are saying as high as 33%. And the tax rate also, which was included in those tax cuts, will go back up, and Mr. Obama has predicted that that even may increase to help offset the losses and the national debt that we're all victims of. With these facts in mind, we'll show you how you can not only take advantage of unprecedented capital gains rates, but also hedge against future inflation, which is predictably going to happen in the upcoming months. Let's first look at the first example. Here we have an 88-unit apartment complex that has no debt. Take it down from the effective gross income and come down to your net operating income. That's what the owner can spend off of the operations of the property, and it creates the value. The value would be at $7,600,000 for this example. You take out the cost of sale, then take out your land basis, your non-depreciated basis, and you have what will show as your taxable gain. That gain then would be taxed at now the 15% as shown, and if the tax rates go up, you can see where they would go if it was at 28% or if it was at 33%. That gives you net after-tax proceeds of your $4,186,250. You add back in your land and your non-depreciated basis, which was used to calculate your capital gains, and you have net after-tax sales proceeds of $6,557,250, which can then be repositioned into a different vehicle to generate income that at least matches, if not exceeds, what you're currently getting from the operations of your property. Let's look at the second example. This is a 64-unit apartment complex. This one, as it shows, has some debt, and it's fully depreciated. Again, you show your effective gross income, your operating expenses, and your net operating income. And here you have to take out your debt service to get to your net cash flow of $193,519. Again, that's what the owner takes home. That creates the value out of your $282,000. You get the value to establish a sales price of $4 million. You take that down, take out your cost of sale, take out your land basis to get to your taxable gain of $3,052,000. Again, at 15%, the tax would be $457,800. At 28%, that's $854,560. At 33%, it's $1,007,160. You then take your loan payoff that has to come out of those after-tax proceeds, add back in your land basis to get to your net after-tax sales proceeds. I think it's important that you know that this is just for, these two examples are shown for illustration purposes only. Your taxes are going to be different. You've got some recapture that has to be paid on depreciation, and you've got state taxes. But for this example, we're showing simply how you can come down to a net after-tax sales proceeds and then reposition these proceeds into an investment vehicle that optimizes your proceeds to at least get what you were earning, if not more. You have the $2,600,000, and we'll also go back and show you how that $6,557,000, how both examples can be repositioned to optimize income. We'll now have Mr. Doug Andrew, a 35-year specialist in the investment field, come and show you how these proceeds can be repositioned to maximize and at least match, if not exceed, on an after-tax basis what you were earning from the operations of your property.
Thanks, Craig. You know, I've been a financial strategist and retirement planning specialist now for more than 35 years, and I've been helping people optimize their assets, equity in real estate, and their retirement accounts to increase liquidity, safety, and rate of return. I wrote a series of books called the Missed Fortune book series because of the fortunes people miss out on when they simply don't know what they don't know. Because of the climate out there in the economy, I feel like the greatest dangers that we're facing right now are increased taxes, inflation, and continued market uncertainty. So in all of the strategies, we want to help eliminate these dangers and seize three great opportunities that you should use tax-free vehicles for your serious cash, link the returns that you get to inflation so that if we experience inflation, it actually helps you instead of hinders you. And number three, I believe in indexing for safety, and I'll explain that more in just a moment. But the three greatest strengths of the Missed Fortune strategies are really to increase liquidity, safety of principal, and earn a predictable rate of return. You know, for many years, I've taught people how to manage or optimize the equity in their real estate to increase liquidity, safety, and rate of return. And oftentimes when it's trapped in the property, we lack those three key elements of a prudent investment. And so whenever I optimize equity by refinancing a property or by selling a property, we're doing it to increase the liquidity, the safety, and also the rate of return. You know, for many years, I've talked about the risk-return paradigm where we have listed here 16 general categories of investments ranked from highest risk to lowest risk. And when we apply the liquidity test, we find that several are not liquid enough when you really need to get to your money. This many more do not pass the safety test. This many more do not pass the rate of return test. So after those three tests, we might end up with three survivors, maybe some annuities, maybe some mutual funds, and then number 12 are maximum funded insurance contracts. Well, annuities are only tax deferred and they're tax LIFO, so it's last in, first out. Mutual funds, especially growth funds, are very very volatile, and even if you earned as much as 8 or 12% after tax, you might only net maybe 7 or 8%. There's only one of these three that gives you a tax-favored harvest, meaning that when you go to harvest your interest or money out for income, there's only one of these three options that accumulates your money tax-free and then allows you to access your money, including the gain tax-free. And when you ultimately pass away, it transfers income tax-free. And that is a maximum funded insurance contract, and this has been grandfathered under the Internal Revenue Code for decades under Section 72E, 7702, and 101A. What this actually does is allows you to be able to put money into a maximum funded insurance contract, meaning that instead of trying to buy a bunch of life insurance, for example, for the least premium, you're doing exactly the opposite. You're trying to get away with the least amount of insurance the IRS will let you get away with and put in the most money, and it creates a cash cow. I've used this repository for my serious cash, my real estate equity for decades, and I've been able to earn a net internal rate of return averaging around 8.2% tax-free, and I'll illustrate how and why. You know, I like to use this metaphor of the story of the three pigs, where we had houses of straw, sticks, and bricks. I equate real estate to houses of sticks. You have moderate risk, and you've done very well with real estate holdings. The stock market is more like houses of straw, and the big bad wolf will occasionally blow down the stock market with recessions and 9/11s and all this market uncertainty, and it also affects the real estate market. Well, I take my serious cash and safely tuck it in a house of bricks. And out of all of the options here, I prefer the maximum funded insurance contract because it passes the liquidity, safety, and rate of return test with flying colors. Basically, what I want you to understand is if I put, let's say, $1 million over here, safely tucked in a house of bricks, it's in a very highly rated insurance company or portfolio of insurance companies, and they have to put that money into special investments that meet the legal reserve requirements that are far more stringent than banks and credit unions. And generally, over the last 3.5 decades, they've averaged around 7.5%. Now, I've earned as high as 15.5% during high interest years like 1980. And in a low interest environment like we're in right now, I've been earning about 5%, but it's tax-free. Well, I can put my money in here, my serious real estate equity, and if on that $1 million I just want to play it safe, they'll pay me that 5%, $50,000, and it's totally tax-free under those sections of the code. But if I want, anytime I can say, this year I want you to pay me whatever the index of my choice earns. So if it's the S&P 500 or the Dow Jones, whatever I choose, let's use the S&P as an example here today. If the S&P goes up 5, I get 5%. If it goes up 10, I get 10. If it goes up 15, I get 15% on my $1 million. That's $150,000. However, if it does higher than that, they have to cap it at 15% in this example, because if I guess wrong and the market goes down, I don't lose. They protect me from loss of principal. My $1 million is safe from loss of principal. I simply relinquished or waived the right to get the 5% in order to have them credit me whatever the S&P does. This is called indexing. So I can actually participate in what the stock market does without my money at risk. I take my real estate equity and safely tuck it over here in the house of bricks and create predictable income, because the big bad wolf is going to continue to blow down the stock market and real estate market. So how does this work? Well, I like to use the metaphor of a bucket. These were originally introduced back in 1980, not by an insurance company, but actually by E.F. Hutton at the time. And they realized that in the Internal Revenue Code, there's only one vehicle that accumulates money tax-free and then allows you to access your money tax-free. And when you ultimately die, it blossoms, it doubles or triples in value off time, and transfers income tax-free. And when you set up an insurance policy, it's like a bucket where you're designing this to hold the amount of capital that you want to put in there to keep it safe. So under these examples, we're going to act like we sold an apartment complex and we took the net proceeds and we're going to put it into a bucket in order to comply with these Internal Revenue Code guidelines. Now, there's 3 tax citations we have to comply with: the TEFRA law of 1982, the DEFRA law of 1984, which dictates the minimum amount of life insurance that has to be attached in order for it to be tax-free. And the older you get away with less insurance, so that if you're going to earn an average return like I have the last 3.5 decades of about 9.2%, I'm actually netting about 8.2% cash on cash tax-free. In other words, about 1% paid for the insurance that the IRS said had to be there in order for it to be tax-free. But when we do that, then we can accumulate the money and take tax-free income. However, in 1988, under the TAMRA law, they restricted how fast we can fill up the bucket, fund it. And it takes about 5 years in order to fill up the bucket in compliance with the TAMRA tax citation. So that means that when we have a large lump sum of money from the proceeds of the sale of an apartment complex, we have to have a temporary parking place, a side fund, where we generate the same predictable income, but it's taxable during that time period, but it eventually fills up the bucket over that 5-year period, so that after 5 years, now all of your income, the rest of your life, is totally tax-free. Let me show you how this works. It's sort of like if you had a 5-story apartment building. You know that if the building is only filled up 20%, it's not really covering your expenses. When you get it 60% full, yeah, it's probably covering all your expenses, but you didn't build a 5-story apartment complex in order just to occupy 60%. When that building is filled up to 90-95% capacity, that's when it turns into the cash cow, as you know. The very same is true of an insurance bucket. We need to get that filled up, and it takes 5 years to do that in order to generate the tax-free income. In the meantime, it can generate the same income or greater that you were getting out of your apartment complex with a lot less headaches. Let me illustrate how this works, because the insurance company, when you have your money actually in the market and the market goes up, if it's in indexed insurance contracts, the gain now becomes principal. See, if your money is exposed in the market and it goes down 10%, you lose, but here you don't lose. You'll continue to earn 0, 1, or 2%. You will not lose principal based upon what you choose. But when the market turns around, you start making money from that point forward. And so in this little 36-month example, it's a $12,000 difference, 12% difference by not losing when the market goes down, but making money the second it turns around. So the actual history of this, the last 10 years, which many economists say has been the worst decade since the Great Depression, I call it the lost decade, where most people who had their money in the market lost 10 years. They're barely back to where they were. So this red line here illustrates the S&P 500, and you'll notice that after 10 years, as we move into the end of the first and even the second quarter of 2011, people are barely up 2.99%. Well, if during that time period you had your money in one of these buckets, you don't lose when the economy goes down. Most 10-year period you have 3 down years and 7 up years. Well, from 2000 to 2010, we had actually 5 down years, 2 of them more than 30%. And so instead of losing, you just stay flat at 0. 5 of those 10 years. I'm using this as an example because it's the worst 10-year period, and you still came out ahead 116%. In other words, $5 million, if this was your equity from the sale of an apartment complex, in the market, you'd barely be back to break even, a little bit in excess, $5,149,000. With an insurance contract using indexing, where 5 years you didn't make anything but you didn't lose, but the other 5 years you participated up to 15% as a cap, your $5 million would be worth $10,827,000. The people that have been following my advice, our clientele, the last decade have at least doubled their money when most Americans barely are getting back to break even. So let's show you what we're talking about with the proceeds of the apartment complex. You remember in Mr. Burton's example, the first one, he showed that this property was generating $432,000 of cash flow after operating expenses, but that's pre-tax. You still have to pay income tax on that, so that's dwindled down by 30 or 40%. Well, I'm going to show you how to equal that or exceed it by using this strategy. We ended up with $6.5 million of net proceeds. So, if we put $6.5 million into a plan like this, an asset optimization equity management plan, we have to park about 80% of it over here in the side fund, and we can have to fill up the bucket over a 5-year period so we can enjoy tax-free income from that point forward. This temporary side fund is designed to give you the same safety, liquidity, and rate of return. You can access your money in 24 hours with a phone call or an electronic funds transfer. You can't do that out of an apartment complex. 100% liquidity here. Your money in the side fund the last 5 years has been averaging between 8 and 12%. So we'll use the average of 10%. You can easily take $450,000 of income annually, which is more than the $432,000 out of the apartment complex. This is taxable the first 5 years, but it exceeds what you were getting from the apartment with no headaches. At the end of 5 years, we're going to have the same income, $450,000 a year, but it's now tax-free. It's not deemed earned, passive, or portfolio income. The IRS knows you received the money, but they know it's not taxable. Let me show you what happens. So the very first year, we fund the bucket 20% in compliance with IRS rules, and the rest of the money in the side fund is giving you cash flow equal to or exceeding what you were getting from the apartments. Even though that's taxable, at the end of year 2, the money begins to flow over, and in year 3, year 4, year 5, you maintained $6.5 million or more of liquidity. And at the end of that time period, we still have $89,000 left in the side bucket, but now the main bucket is full and it generates the $450,000 of tax-free income. In fact, not only does it generate $450,000 of tax-free income, but let's say that you were to pass away at age 80, you would leave behind in excess of $11 million tax-free, and it could be estate tax-free. If you passed away at age 90, it would blossom to about $13 million when you passed away. It's far greater than having the money staying in the apartment complexes. You remember from the second example, you were realizing $193,000 of cash flow. Using the same illustration, we generated over $200,000 of income. The first 5 years, it was taxable. We exceeded this. But after 5 years, it generates $200,000 a year of tax-free cash flow that lasts as long as you do. And when you ultimately pass away, it blossoms in value because it's an insurance contract and it transfers income tax-free. And so most of our clientele that sell highly appreciated real estate and they want to know what to do with the net proceeds, they choose, when they see all of the options, the maximum funded insurance contract, because it's the only vehicle that provides liquidity, safety, earns a great rate of return that's predictable. It's totally tax-free. These are the 3 key elements that we want to make sure you understand. Liquidity is number 1. Number 2 is safety of your principal. You don't lose principal. And number 3 is earning a predictable rate of return. That is the strategic tax and equity planning that is the solution for your multifamily assets to seize this opportunity during this window of time when we can sell these properties, pay the capital gain tax at 15% rather than postpone and pay 28 or 33%, and reposition the money into something that's going to pass the liquidity, safety, and rate of return test and create tax-free cash flow that far exceeds the net after-tax cash flow you had from your property.